Part 2. We want to show how unearned revenue now, at the end of February, is going to be converted into earned revenue. We know unearned revenue is a natural credit because it's a liability. And now when we earn it, it's as if we're paying off an accounts payable because that liability is now decreasing. Decreasing because we've performed the service. The unearned revenue is decreasing. How do you decrease a natural credit here? By debiting it for the value of what has been performed. In this case, $400, 2 months worth. Unearned revenue will be debited for the $400. And now we say we're going to convert it into earned revenue. So you indent a little bit to show what you're going to credit here. And you go earned revenue. Or you can call it piano revenue. Depending on the company, they will specify exactly what they want this revenue account to be called. Could be service revenue, okay? But the main thing to know is that it's going from an unearned revenue to an earned revenue. And then whatever you call it is just depending on the specific company. So earned revenue now gets credited for this 400. Okay? And then, of course, at the end of March, this exact entry on March 29th or March 31st for the remaining 200 once you earn what is left. Okay? And now you've journalized and you know how to kind of play with the debits and the credits and how to show it in a general journal. Okay. So same idea when you're journalizing. And just to make sure here, the revenue here that's credited, revenues are natural credits. They're natural credits. How do we increase natural credits? By crediting them. Okay, earned revenue, it's increasing. Credit it in the same direction of its natural balance. Enthralling stuff, huh? Those principles that we just applied in the journal can now also be applied in what's called a T account. A T account. And the T account, because it looks exactly as it sounds. T account is in the shape of a T, and each of those accounts in the chart of accounts will have their own T account. Cash, accounts receivable, T account. Accounts payable, T account. Capital. Every single account in your chart of accounts will have its own T account. And the T account is also like saying your ledger, your general ledger. The slight difference between a T account and a general ledger account, because each of these also is in the ledger. So cash has its own T account, cash has its own general ledger account. Same thing for accounts receivable and all of the others. The difference between them is that the T account is more like a draft version of the ledger account. It's more like you're just working it out. But the ledger is more of a formalized version of it, a more organized, formalized way. But the rules and the principles we use when recording in the T accounts or the general ledger are the same. Okay, they're the same. The left side is your debit side, the right side is your credit side. For all of the accounts. For all of the accounts. Now it just comes back to that question. When you're dealing with an account, you ask yourself, what is the natural balance of it? then you will know whether to put the amount on the left side, debit, or the right side, credit. And then it's the same rule when you do the general ledger. Okay? So you don't have to do both the T account and the general ledger when you actually are starting to go into the accounting equation. For some of the practice questions and on the tests or the assignment, whatever, you might be asked to do a T account. But that's just for that question, right? When it comes time to actually do the accounting cycle, the T account will become the ledger because you're doing the exact same thing. You're either increasing it on the left side or debiting it on the left side, or crediting it on the right side. All right? So let's take those examples that we did in the regular journal. When we had the general journal there, you're applying the same principles. The same principles. And let's actually, yeah. Here, I'll have prepaid ski lessons. Prepaid ski lessons is its own T account because it is another account in our chart of accounts. Okay, we use cash to pay for that, and we can say, what do we call it? Ski expense when we actually used it. When we actually used some of those prepaid lessons, they become expenses because we use them, right? So here's our T accounts of the accounts that we have journalized. And I'll even put unearned revenue as a T account. Okay. And earned revenue will have its own T account. Okay. So T accounts, think of exactly what we did in the general journal, in those individual journal entries. Exactly what we did in those is what we're going to do in the T account. We're following the same rules. Everything is consistent in accounting here. Let's look back to that first transaction. We prepaid for ski lessons. $4,000, right? $4,000 ski lessons for 4 months. That means $1,000 per month. Remember again, each of these T accounts, for all of them, you could have 50,000 different accounts here on the board. All 50,000 of them means you're debiting on the left side and you're crediting on the right side, regardless of its natural balance. Okay? But in order to know whether you're going to put the number in the left or the right side, you have to know what the natural balance of the account is. So let's actually practice what the natural balance of each of these is before we start recording the transactions. What's cash? And I'll put either D or C for debit or credit. Cash is an asset, therefore a natural. Okay, keep going. Accounts payable is a natural is a liability. That means it's a natural. All right. Unearned revenue, liability, therefore natural. Okay. AR, natural. That's right, because it is an asset. Debits are assets. Assets are debits. Capital, natural. Okay. Earned revenue this time. So this is the real revenue. You've performed the service. You've sent the product. Earned revenue is C. It increases equity. It is also a natural credit balance. Prepaid ski lessons. prepaid ski lessons are assets, therefore natural good. Ski lesson, this is ski lessons expense, by the way. Expenses are natural. They decrease revenues, they decrease equity, so they are natural. Right, because they have to be opposite to real revenue and capital. Natural debits. So now you know the natural balances, now you'll know exactly which side to put it on. If you're putting it on the left, the number, it's a debit. If you're putting it on the right, it's a credit for all of these. First transaction, we prepaid ski lessons for 4 months, $1,000 per month. Therefore, the initial payment is for $4,000. The account that you're debiting goes first. You paid for it. You acquired an asset. When you pay for something, you're either paying for an expense or you're getting an asset. In this case, the asset is prepaid ski lessons. Prepaid ski lessons for $4,000. Which side are we putting it on? Remember, left side is for debits, right side is for credits. We are increasing the ski lessons. First question, natural. Okay. That means we have to put it on the left side because we're debiting it. And then you would put the date here. Okay. January 29th is more of a date than a squiggly line. Okay. January 29th, 4,000 is the asset. We pay for it with cash. Cash is a natural good. If we put it on the left side, we are debiting it, but we know that it is decreasing. That means it has to go on the right side. J29. Okay? Cash is decreasing, so it's credited, right side. And now you just did that same general journal entry in a T account. It's the same idea, same principles applied. What happened next? End of February means we used up 1 month of those ski lessons. We already made that association that as soon as something is used, it becomes an expense. 1 month of this asset has become an expense. Expenses are natural debits. That means on February 28th, that covers 1 month, 1 out of the 4 months, totaling $1,000. If we're debiting it, we put it on left side. The expense is increasing, you put it on the left side. You're debiting it. That means the asset is going down by that same 1,000. So we have to go find the asset T account. What is the asset? Prepaid ski lessons, right here. And on February 28th, we want to decrease prepaid ski lessons by the amount we use, the same 1,000. It's a natural debit. We want to decrease it, so we will put it on the right side. Right side to signify that we are crediting it on February 28th. So now if you do a running balance, how much do you have left in prepaid ski lessons? 3,000. 4,000 debited here, 1,000 credited here. Current balance, 3,000. Footing and final balance, by the way, other terminology when we're using T accounts. Footing just means we're totaling the debits, 4,000, totaling the credits, 1,000, and then final balance or current updated balance, 3,000. Okay? Footing is one side, debits total, credits total, and now final balance based on those totals is how you do those. Excuse me. So now we've just taken those journal entries and put them into T accounts. We've reflected them into T accounts. Let's take the investment into the company. That $100,000 cash investment, along with the $50,000 of equipment that you invest into the company. In the journal entry, we debited cash for the $100,000, debited equipment for the $50,000, and then credited capital for the $150,000. Now we're going to show that in the T account. Cash increasing by $100,000. It's a first question again. It's a natural. All right. Natural debit. So I'll just put January 29th again. That means we are debiting it or crediting it. It is increasing. Follow the natural balance. 100,000. Right side. This is the investment in the company. We also invested $50,000 worth of equipment. So now let's search for the equipment T account. There is not one. So let's squeeze it here. Equipment. Here we go. It's created. Equipment, January 29th for $50K. Natural D. Okay? Natural debit. January 29th, $50,000 of equipment is also invested in the business. It goes on the left side because it's increasing. Debit's on the left. You want to increase the natural debit. Now that $150,000 that was credited in the journal entry we have to find the capital T account. Let's look for it. It's right in the middle. You want to increase a natural credit account. We've already established that it's a natural credit. Equities are natural credits. How do you increase a natural credit? Give it more of its own balance. Give it more of its natural balance. Therefore, on the left or right side? Right side. 150,000, January 29th. You see? Debit cash, left side. Debit equipment, left side. Credit capital, right side. Exactly the same thing was done in the journal entry. It just looks different in the way that it's prepared, in the way that it's presented. But everything is staying consistent with how we are treating the accounts. And now you have an idea on how to apply the unearned and the earned revenue. Right? First question is, make sure you know what its natural balance is. Then it's very simple to know which side to put it on. Okay, and again, the ledger is just a formalized version of this. That's it. A formalized version of this where the account is listed, and then either you're debiting it or crediting it in two columns. Okay, and that's where, when we start talking about the accounting equation, which really we're doing in this chapter, the first step is to analyze and then journalize. So you already know that. It's an 8-step accounting cycle. The first step is analyze and journalize. The second step is post. Sometimes it'll just say post. And post means to the ledger. So whatever you did in the journal entry, you post to the ledger. We just did that we just posted it into T accounts. Okay, but now you know that a T account is a ledger. Just a more rough idea of it. All right? So post means from the journal, all the information in the journal, post it to the ledger. And it becomes very simple because everything you did in the journal entry, you just copy into the ledger now. If you debited cash in the journal entry, go find the cash ledger or T account and debit it in there. If you credited accounts payable in the journal entry, go find the accounts payable T account or ledger and credit for that amount in there. Right? You just copy. Just so there's a connection and a link between those two steps. And one additional thing that will be included in these, whether they are T accounts or ledgers, is that account number that we listed at the beginning of the chapter when we were talking about chart of accounts. So the cash, let's say 101, so that's why you'll just have a 101 off to the corner, especially when talking about the ledgers. Because again, the ledgers are more formalized, so they will have more detail. Cash, 101, accounts receivable, 102, prepaid ski lessons, let's say that one's 105, okay? Assets all in the 100s, liabilities 200s, and you get the point. Okay, so there's T accounts, there's ledgers, and now you take all these T accounts. Remember we talked about the footing before I erase it. The footing, what is the total of debits in each of the T accounts? Total of debits, or the left column of each of them. What is the total of credits for each of these T accounts, or the right side of each of them? That's, now you're footing them. Now, what is the final balance? So in the prepaid ski lessons, it's 3,000. Let's do the cash one. Cash, we used 4,000, and then we invested 100,000. So what's the footing? Means debits are 100,000. Credits for the cash account are 4,000. That means the final balance, or the current running total, is 96,000. And you're always going to put the balance on the heavier side. Wherever there's the balance, it goes on the heavier side. If the balance is 0, and you're not sure what side to put it on its natural balance side. Right? So if accounts payable, we pay for something with credit, that means we're putting it on the right side, let's say $200, and then we pay off that accounts payable, so that means it's decreasing, and therefore debited. Now guess what? It's 0. But which side do you put that 0 on? Put it on the natural balance side. If accounts payable is a natural credit, so put that 0 on the credit side. Okay, cash is a natural debit, put the 0 on the debit side. But make sure you never have 0 in cash, in real life especially. Right? So now you take those final balances of each of the T accounts, and more copying now into that third step in the accounting cycle. Okay, again, first step, analyze and journalize, then take that information and post it into the general ledger, each of the accounts that are related to that journal entry, to each of the journal entries. Then the third step is taking the final balance in each of those ledgers and copying them into the trial balance. Copying them into the trial balance. So how do we set up a trial balance? The hard work so far out of these 3 steps is the journalizing. That's where you have to make sure you know what is occurring. That's what the first step says, analyze and journalize. Analyze means comprehend what is happening here. What is the transaction? And once you are confident that you've identified that, now you journalize that transaction and record the appropriate accounts. All right? For the appropriate amounts. So that's step one. And now, so analyze and journalize. Step one. Step two, post to ledger, and I'll put in brackets T account, T accounts, because it's the same thing. And now three, trial balance. And really it's called the unadjusted trial balance. Unadjusted, meaning we are still going to adjust it. But here, as far as step three goes, it's the unadjusted. Meaning it's the current trial balance. Whatever those balances are, just get copied from the ledger into the trial balance. And a trial balance is simply a listing of all of the accounts in the left column, followed by, so there's the first column. Now you have a second column, DR, the debit, and then a third column, credit, in the far right, so that you have enough room to write out the account names. And that's it. 3 columns, trial balance. The first step when preparing the trial balance is to list all of the accounts. You are going to list all of the accounts in your chart of accounts. And that's why this part is very simple, to know which order it goes into. You list the assets first, the 100s from the chart of accounts, then the 200 liabilities, the 300 equity accounts, the 400 revenues, and the 500 expenses. Right? That's what order you list them into. Another way to know is based on liquidity, which is already how the chart of accounts are listed. But if you're ever stuck, either copy out the chart of accounts or list them according to liquidity. And then actually a third way is list them according to the account numbers, if you have access to that. That's how you know how to do this. So there, for cash, accounts receivable, and I'll just do those 2 assets. Then we'll go accounts payable. Okay, that's fine. Then equity accounts, capital. Okay, followed by revenue, followed by expenses. And then of course each of these will have a few more, but this is just to show you the order. And now, remember that final balance that we calculated in each of the T accounts. Cash, 96,000 debit. Prepaid ski lessons, 3,000 debit. Remember? Accounts payable, 0. So those final numbers are the only ones that you need to now copy into this trial balance. Cash first. You can go one by one. Cash, go look to that cash ledger. See that it is a 96,000 debit balance. And then simply copy 96,000 in the debit column. 96 debit balance in the ledger. That's why it goes in the debit column here. And cash virtually will always be a debit. Okay? Accounts receivable, you go to that ledger. How much what's that final balance there? Simply copy that number here into the debit column. I'll just make up right here 100. Okay? Go to the accounts payable ledger. 0. But be careful now that you're putting it on in the credit column here. Accounts payable, 0. Okay? Capital. We'll go to the capital ledger. We said the final balance is $150,000, if you remember. The cash investment plus the equipment investment. So $150,000 investment, debit or credit side. Capital has to be a credit. Again, just copying what it is in the ledger. There's no extra work here. Trial balance is a very smooth step to perform. And if you did step 1 and 2 properly, this one will balance at the end. And by the way, that's the goal of the trial balance, is to, once you've listed all of the accounts, now you have total debits and total credits. And the goal is to have these two match. They have to equal. Otherwise, you cannot continue on to step 4, 5, and 6. They have to equal, and the way you will get confirmation that you did step 1 and 2 properly is if these two balance. And that's why it's important to always be sure whether you're putting it in the debit column or the credit column here. Okay? Because that even one misstep could throw off the whole trial balance. All right, so revenues now. Revenues, let's say 10,000. Just made that up. By the way, credit, right? Revenues are natural credit balances. If we look to that revenue ledger, we would find the capital. We would find that it goes in the same direction as capital and therefore a natural credit balance. And then expenses go, of course, each individual expense will be listed, but let's suppose here total expenses, and we'll make it so that this balances. So this is 160,000. This is 96,100. So therefore, 3,900, 63,900. 63,900, let's suppose, is the total of expenses. Meaning you have 150K debit total and 160K, excuse me. 160,000 credit total, 160,000 debit total. Okay? And now you've completed the first 3 steps in the accounting cycle and how they relate to each other. We'll go into more explanation about this when we actually get to the next chapter, chapter 3, 4, and 5. But now at least you have a foundation on how they are related to each other and how we can transition from one step to the next. And more importantly, what exactly terminology means in accounting. For example, how to journalize, how to record in the T accounts, which are exactly ledgers, just more draft calculations of them. How to go from T accounts into the trial balance. Okay, and all of that is keeping in mind the natural balances of each of the accounts. And we know that we list them in order based on how they're listed in the chart of accounts, which has account numbers. And then you can also think about the liquidity, how quickly we can convert them into cash to know which order they go into. And then another way, assets first, followed by liabilities, then equity, then revenues, then expenses, which you may have noticed is the same order that we listed the categories back in chapter 1, the 5 main categories to know in this course. in accounting, really. And now, what you can do with the trial balance, as it relates to this chapter, is prepare those financial statements. So you can take the relevant accounts and extract them into the appropriate financial statement. And it's the same three that we did in chapter 1, in the same order. First, you want to look at the revenue accounts, or excuse me, the income statement accounts, because that's the first financial statement. From our condensed list of accounts here, which ones apply to the income statement? Categories 4 and 5, revenues and expenses. So these two, we'll take all of the revenues listed in the trial balance, all of the expenses listed in this trial balance, and put them into a formalized preparation of the income statement. The goal of the income statement is to determine what? Profit, which is also called, two words, net income. Once you determine that net income, you can do the statement of owner's equity, which is the second financial statement. The statement of owner's equity will start with beginning capital, the 150, right? The 150, you're taking it right from the trial balance, just like you took all the revenues and expenses from the trial balance into the income statement. Now, to start off the statement of owner's equity, take this 150 from the trial balance as your beginning capital, add any additional investment if there was any during the month, any additional investment, and then add this net income that you determine in the income statement. Add the net income. If it's a net loss, meaning expenses are more than revenues, then deduct that net loss from the running total. And then there's another account that could possibly be listed here after capital, which is withdrawals, because it's directly related to equity. Withdrawals, by the way, if it decreases capital, what is withdrawals' natural balance? Capital is a natural credit, so withdrawals has to be a natural debit. Good. If withdrawals is listed here in the trial balance, we take that debit amount, remember to put it in the left column, that debited amount, and subtract it from that running balance in your statement of owner's equity. And now you either have an increase or decrease in capital from the point of listing your beginning capital. It's either an increase or decrease in capital, right? Which you will add or subtract to that beginning capital. Okay? Beginning capital plus additional investment plus net income minus withdrawals gives us ending capital, which is the goal of the statement of owner's equity. Okay, all of this stuff we wrote out in chapter 1. That's why we're just reiterating it, re-emphasizing it here in this video. Right? If you want an explanation on how those are set up and what is included in each of those financial statements, go back to the chapter 1 video. But especially after the assignment, you should know how those are exactly structured and what goes inside of them. So you have you got your goal accomplished from the income statement by finding out net income. You took that net income into the statement of owner's equity, which is the second financial statement, and you achieved your goal now in that statement by determining ending capital. So it went from 150 starting, and now it's another number. And you take that ending capital now, and you prepare the balance sheet. First in the balance sheet is the assets. So we'll find our assets here. In this case, cash and accounts receivable. Take the numbers here, 96,100, copy them into the assets section of the balance sheet, get a total assets. Now go into the liabilities and owner's equity section, because remember, those two combined must equal assets. You take liabilities first. Where are our liabilities? In this case, we have 1, accounts payable. Take that amount, 0, put it into the balance sheet liability section. Total liabilities, 0. Now, equity section. You take the capital amount that you calculated in the previous financial statement, the statement of owner's equity. That amount gets inputted into that equity section, into that representing that capital amount. And now liabilities and equity together should equal assets. And now you've balanced the balance sheet. Okay? And now that concludes chapter 2. If you have any additional questions to this, post them in the discussion board, email me, help each other out in the discussion board, and rewind the video if necessary. Otherwise, you can start the practice questions. I'll post the solutions to them later this week, probably Friday, and then you can review those before you actually do the assignment, depending on your comfort level. Of course, if you're ready to do the assignment now, go ahead, but that can give you an idea or some help on how to do the assignment to really grasp what you're doing. Okay. That's it for this week.